The dollar and the diffusion of monetary power, hegemony, hedging, and the architecture of a changing global currency order. The modern international monetary system is built upon an extraordinary historical anomaly, a national currency that functions as the world's primary medium of exchange, store of value, and unit of account. Since the mid-20th century, the United States dollar has occupied this position with the level of dominance unmatched by any previous currency regimes. Its role is not merely financial but civilizational in scale, shaping trade flows, geopolitical alignment, capital markets, and even the strategic calculation of states. Yet, as the 21st century advances into an era defined by multipolar power distribution, technological disruption, and intensifying geopolitical rivalry, the question of whether the dollar supremacy is secure or gradually eroding has moved from an academic debate to a strategic policy concern across capitals worldwide. The foundations of dollar hegemony were laid in the aftermath of the Second World War when the Bretton Woods system institutionalized the dollar as the anchor of global finance. Even after the collapse of the gold convertibility standard in 1971, the dollar retained its dominance because no alternative currency could match the combination of liquidity, stability, market depth, institutional credibility, and military backing that the United States provided. Oil markets priced in dollars reinforced this status, creating the so-called petrodollar system that ensured global demand for the currency. Over time, this demand generated a powerful network event. The more actors used dollars, the more indispensable they became. Until global trade and finance were structured intertwined with American monetary infrastructure, today the dollar is still used in the majority of international transactions, and central banks continue to hold most of their reserves in dollar-dominated assets. This persistent dominance gives the United States structural advantages often described as exorbitant privilege. Because global demand for dollar is constant, the US can finance deficits at lower borrowing cost than other nations. American sanctions have global reach because access to dollar clearing system is essential for international trade. US finance institutions benefit from transaction flows, and American monetary policy decisions reverberate worldwide. The dollar is therefore not just a currency but an instrument of systematic influence embedded in the architecture of global power. Yet the very concentration of power that made the dollar dominant has also generated incentives for other states to reduce dependency on it. The past decade, a growing number of countries, especially in the global south, have begun exploring mechanisms to conduct trade without using the dollar as intermediary. These efforts are not new in concept. Bilateral trade in local currency has existed for decades. What is new in this frequency, scale, and geopolitical motivation behind such arrangements? Nations are increasingly aware that reliance on a single external currency exposes them to exchange rate risks, transaction costs, and political leverage. The logic is straightforward and brutal. If two countries can trade directly in their own currencies, they avoid conversion losses and reduce vulnerability to external financial pressure. China has been at the forefront of these initiatives, promoting the internationalization of the renminbi through bilateral agreements and alternative payment systems. Its cross-border interbank system (CIPS) is designed as a parallel channel to the Western-dominated SWIFT network, allowing banks to settle transactions directly in yuan. Several countries and financial institutions have begun linking into this infrastructure, enabling trade settlements that bypass the dollar entirely. Brazil, for instance, has increasingly conducted trade with China using the real and yuan, particularly in commodity exports such as soybeans. India and the United Emirates have experimented with rupee dirham transaction, while Russia and China have shifted large share of their bilateral trade into local currencies, partly as a response to sanctions. In energy markets, China has purchased oil from Iran and Russia using yuan, demonstrating that even sectors historically tied to dollar pricing can accommodate alternatives under certain geopolitical conditions. Parallel to these bilateral initiatives is a broader institutional effort among emerging economies to construct alternative financial architecture within the BRICS grouping. Proposals such as BRICS Pay and digital currency platforms like Project MBridge aim to create decentralized systems that allows cross-border transactions without reliance on Western financial networks. Although these projects remain in development or experimental stage, their strategic significance lies less in immediate adoption and more in the signaling effect. They represent a deliberate attempt to design parallel infrastructure that could, over time, dilute the dollar's monopoly over global payments. Technological innovation further accelerates this shift. Blockchain-based settlement systems, central bank digital currencies, and real-time cross-border payment platforms reduce the friction historically associated with non-dollar transactions. In the past, the logical complexity of currency conversion and settlement reinforced the dollar credible centrality. Today's digital infrastructure can perform this function instantly, lowering barriers to use alternative currency. Technology doesn't automatically dethrone the dollar, but it erodes one of the structural advantages that sustained its dominance for decades. Geopolitical dynamics can also play a decisive role. Sanctions regime imposed by the United States and its allies have demonstrated how financial infrastructure can be weaponized. Countries that have experienced or fear such measures increasingly seek ways to insulate themselves from external control. For them, diversifying away from the dollar is not merely an economic decision, but a strategic hedge. Holding reserves in multiple currency, accumulating gold, and establishing alternative settlement channels are in forms of financial risk management in an uncertain geopolitical environment. Rising gold prices in recent years have been interpreted by some analysts as an evidence of this hedging behavior, reflecting a desire among states to hold assets that are politically neutral and immune to sanctions. Despite these developments, replacing the dollar outright remains extraordinarily difficult. A global reserve currency must satisfy a demanding set of conditions: deep and liquid financial markets, transparent governance, and macroeconomic stability. The widespread international trust. At present, no other currency fully meets all these criteria. Euro is widely used but constrained by the fragmented fiscal structure of the Eurozone. The Chinese yuan is backed by a massive economy but limited by capital controls and concerns over transparency. Other countries lack the scale institutional credibility required for global adoption. As a result, even countries seeking alternatives often continue to rely on the dollar for a large share of their transactions and reserves. Practical considerations reinforce this inertia. When two countries with limited trade volumes interact, holding each other's currency may be inefficient. Converting into a widely accepted intermediary currency simplifies transactions and reduces risks. The dollar functions as the universal intermediary, solving coordinated problems in the global trade. This role is self-intermediary, solving coordination problems in global trade. This role is self-enforcing because everyone trusts that others will accept dollars. They continue to use them, perpetuating the cycle of dominance. Breaking such a network equilibrium requires not just alternatives, but alternatives that are equally convenient, trusted, and liquid on a global scale. Consequently, most analysts do not foresee a sudden collapse of the dollar supremacy. Instead, the more plausible trajectory is gradual diversification. In this scenario, the dollar remains the primary global currency, but its share of transactions reserves slowly declines as the regional systems and bilateral arrangements expand. The world would shift from an unipolar monetary order to a multipolar one in which several currencies coexist, each dominant within a certain geographic or sectoral spheres. Such a transformation would mirror broader geopolitical trends as global economic powers diffuse from a single hegemon towards a multiple center system. Some observers interpret this process through the lens of historical cycles of hegemony. Empires and dominant powers often experience periods of ascent, peak, and relative decline over spans of several decades. By this reason, the dollar's current position may represent not an imminent collapse but a later phase of dominance characterized by a gradual erosion rather than abrupt displacement. A slow burn decline could be more consequential than a sudden fall because it creates prolonged uncertainty, prompting states to hedge. diversification and experiment with alternatives long before any definitive transition occurs. The ultimate scenario that could fundamentally challenge dollar supremacy would also involve a structural shift in commodity price, particularly energy. If global markets were to adopt a different currency, such as the yuan, for pricing and settlement, network effects sustaining the petrodollar system could weaken dramatically. Energy markets underpin global trade and their currency domination influences reserve preferences worldwide. However, such a shift would require not only economic adjustment but also geopolitical realignments, making it a long-term possibility rather than an immediate development. For the United States, maintaining dollar dominance is not merely an economic objective but a matter of national power. Policies that reinforce financial stability, market openness, and institutional credibility are therefore strategic priorities. Legislative frameworks for dollar denominated digital assets, therefore, to preserve the attractiveness of US financial markets and diplomatic initiatives that sustain confidence in American leadership, all serve to protect the currency's global role. The dollar's strength ultimately rests on perceived reliability of the system behind it. The erosion of that perception would be dangerous than any single policy or competitor. The emerging global currency landscape thus reflects a paradox. On one hand, the dollar remains unparalleled in scale, liquidity, and trust, ensuring its central role for the foreseeable future. On the other hand, the incentives for diversification are intensifying, and technological as well as geopolitical forces are lowering barriers to alternatives. The result is not a binary contest between dominance and collapse, but a gradual reconfiguration of monetary power. Instead of a single hegemonic currency, the future may feature a layered system in which the dollar coexists with regional currencies, digital settlement platforms, and commodity linked payments arrangements. Such a transformation would reshape not only financial markets but also international relations. Currency systems influences alliances, trade routes, and strategic dependence. A more diversified monetary order could reduce the ability of any single state to exert unilateral financial pressure, but also increasing complexity and competition among economic blocs. For businesses, it would mean navigating multiple settlement systems and export exposures. For governments, it would mean require more sophisticated reserve management and monetary diplomacy. For the global economy as a whole, it would mark the transition from a post-war order defined by American financial primacy to a pluralist structure reflecting the distributed realities of 21st century power. In this evolving environment, the debate over whether the dollar is a wounded hegemon or an unassailable pillar misses the deeper point. The real story is about the fall of one currency, but about the transformation of the system that surrounds it. The dollar may maintain dominance for decades, yet its environment is changing in ways that gradually dilute exclusivity and redistribute influence. What is emerging is not a post dollar world, but a world in which the dollar must share space with others. A world where monetary authority is negotiated rather than assumed, and where the architecture of global finance reflects the balance of power rather than a single center of gravity.